Alright, we're back at the stream. Gonna keep going through my flashcards right now, and then I have class, and I think I have a review session coming up soon. So yeah, let's get to it then. Rent yield in real estate is the amount of rent that some type of property will earn with, I guess, in proportion to the total value of the actual property itself. Okay. Rule 72 is just a way of making quick computations on how much a investment will double, and the idea of the Rule 72 is that investment doubles, and you can calculate the amount of time it takes for your investment to double it by dividing 72 by the annual expected return. In geometric Brownian motion, as the number of periods m becomes really large, what are the underlying forces affecting the expected value? So when the number of periods becomes really large, the underlying returns that affect the expected value get smaller and smaller, meaning that there are a small portion of returns that actually contribute to the large expected value of the asset price. What is the main difference with the units of increments of geometric Brownian motion versus Brownian motion? Geometric Brownian motion, we're looking at a ratio of prices in different times. And Brownian motion process, the increment is looking at the difference in the price at different times. Creditor is someone who is lending money. Jensen's alpha is a measure of how much some type of portfolio or asset is doing better than the actual market and the risk-free rate. Geometric Brownian motion is just a stochastic random process. So stochastic process, and it's used to model stock price returns. Okay, it's the exponentiation of a Brownian motion process. What does the factor sigma delta t represent in the log volatility, which is equal to sigma times square root of delta t of a geometric Brownian motion process? The factor sigma delta t represents the square root of delta t is the standard deviation adjusted time factor when looking at the log volatility. How can we use Godin's growth formula to develop an approximate model for real estate? What are the assumptions? We can use Godin's growth formula to develop an approximate model for real estate by trying to... I think we can use it to predict the cash flows we receive on our property. And so maybe that's the rent yield subtracted by the cost as a fraction of the actual property. And then we divide, so that's our D, right? That's our dividend. And then the denominator will be the cost of capital minus our growth. And then I think the assumption is that we have some type of measure of the cost and the rent as a fraction of the property value. So value profit times y minus. happens to the relationship between compound and simple interest when 1 over frequency is greater than m? So frequency is the number of compounding periods in a year. M is the maturity in years, and we assume that Rs is equal to Rm. So the simple interest rate is equal to the compound interest rate. And then if 1 over frequency is greater than m, that means our actual compound period is greater than a year. And so I would think that with simple interest, Rs would be greater, the amount of money earned from simple interest might be greater than the amount of money earned from compound interest. Because frequency is less than m. There's an intuitive way to generalize the demand function for a portfolio that invests alpha in a risky asset, 1 minus alpha in a risk-free asset. The demand function of a portfolio that invests alpha in a risky asset is going to be x is equal to pi over rho times sigma squared. So it's the risk-free, it's the excess return divided by our risk aversion parameter, and we multiply that risk aversion parameter by sigma squared, which is the variance of the portfolio. What is the log volatility of a geometric Brownian motion process? The log volatility of a geometric Brownian motion process is simply the sigma times square root of delta t. So it's a standard deviation of the log of p of t plus delta t over p of t. I think it should be annual, right? I guess it depends. Log volatility time unit depends on this is also standard deviation of returns. Okay. What is the capitalization rate K in the Gordon growth model? What does this signify? The capitalization rate K is the R minus G term in the Gordon growth model. And I think it signifies the amount of return that is not accounted for by growth. Co-investments are investments that people make along, that funds make along with private equity. They don't have to directly invest through the private equity fund. Then GDP. So R bar can be interpreted by an investor as the required rate of return, the expected return from issuing equity could be the cost of capital. So this is what we have in our denominator. Dividends. Okay. Components of the expected return of a risky asset include the risk premium and also the risk-free rates. Two advantages over a geometric Brownian motion over Brownian motion. So one, I believe, is that the prices never become negative with a geometric Brownian motion. And two, the log volatility and percentage standard deviation and the percentage volatility are both constants that oh wait, no, they actually don't. They do depend on delta t. I think maybe it's because they're log normally distributed. But it does depend on T or P of T though. Okay. Yeah, because I thought this does depend on P of T. Yes, maybe it depends on delta T. Okay. What is rent yield in real estate? So rent yield is the amount of rent that a property earns as a fraction of the total value of the property. What is a sigma square constant called when observing the variance of the increments to the Brownian motion process P of T plus delta T minus P of T? So this is the instantaneous variance, and it just represents the squared standard deviation of returns. Economists assumes that investors try to maximize the expected utility of an investment, which is the idea that investors are risk averse, so that the utility function should be concave and monotonically increasing. Try to achieve the highest amount of return while staying within their risk appetite. Oh, George Soros. Okay, I think something with the European. Something with some agency, the European Currency Agency. They were in charge of making sure that the British pound and the Deutsche Marks didn't have more than a 6% deviation with each other. I think this is before the euro. And George Soros didn't believe that would happen, and I think shorted the pound. European exchange rates mechanism. So. Okay. How can you express the Gordon growth model by factoring it in the risk premium of a risky asset? So the Gordon growth model can be expressed as the dividend at time 0 times 1 plus g times delta t, and then we divide that by pi minus pi plus rf minus g. What is the variance of the increments proportional to in a Brownian motion process? The variance of the increments are directly proportional to the actual time itself, change in time. Okay. 4 types of hedge fund strategies: absolute return, event risk, global macro, and diversified. I guess directional event risk. Okay. What is the capitalization rate in the Gordon growth model? What does it signify? So the capitalization rate is R minus G, and apparently it signifies the dividend yield. So I believe the dividend yield is the amount of dividends divided by the price of the assets. And so the capitalization rates. Okay. So how much the dividends are yielding per price? How can we use the Gordon's growth formula to develop an approximate model for real estate? What are the assumptions? So we can use Gordon's growth formula to kind of model the forecasted cash flows of some risky asset. In this case, it's real estate, which we can think of our dividends as the value of our property times, we'll call times what the rent yield minus the cost as a fraction of value, and then we divide that by the required rate of return, or the cost of capital, and the growth rates. What happens as the standard deviation returns increases for the Sharpe ratio? How does this illustrate the normalization of risk? So when the standard deviation of returns increase for the Sharpe ratio, that means the underlying Sharpe ratio would decrease because our denominator is higher. And so this illustrates the normalization of risk because we're kind of scaling our actual excess return by the amount of risk we've taken on. What are some costs associated with property ownership? So some costs could be property taxes, insurance, property upkeep, and then reinvestment into the property, transaction costs too. Property tax, insurance, transaction costs, routine maintenance, and investment costs. What is an intuitive way to think about risk aversion for investors? Investors prefer higher means and lower variances. There are two important properties of Brownian motion process. One, the returns are normally distributed with a mean of 0 and standard deviation, or I guess a variance of sigma squared. And also, another important property is that the actual variance itself of a Brownian motion process is constant. I'm so fuck. Okay. Yeah, never mind. Sigma squared times delta t, right? Because the variance increases. Okay, actually, I think I have class now, so I'm going to global macro funds just invest in broad range of asset classes, different countries. Alright, 35 more left. It's not bad actually. Yeah, I got 23 more left, and I got class, so I'm gonna end the stream right now and then pick it back up after. Bye.